Buying a home can be confusing, but don't worry, I'm here today to make it easy. Today I'm going to be covering how to buy a house for absolute beginners. And if you watch all the way to the end, I'm sure you'll find some tips and tricks that'll make it easy for you to make that offer on your first new home. So for those of you who don't know me, my name is Andre Dugas. I'm a local realtor here in the Des Moines area, and I love helping everybody find a home, even if it's not your first one, but those first-time home buyers are fun to deal with. So what I'm going to cover in this video is, first, I'm going to cover the benefits of home ownership. The next thing I'm going to cover is preparing to buy your first home. And then we're going to talk about the home buying process. And at the end, if you have any questions, I'll be happy to answer them in the comments below. So put all your questions there and I'll get to everyone. So let's look at owning a home versus renting a home. One of the great things about owning a home is that your mortgage payment is going to stay the same for the life of the loan. Most people get a 30-year fixed loan, or anyway, just a fixed rate loan. Your mortgage payment is going to stay the same for the life of the loan. But if you're renting a home, then your rent can and probably does go up each and every year. In some places, depending on where you live, rent could possibly go up as much as 10% per year. So at the end of the 30-year period, you're going to be paying a whole lot more for rent than you will be for owning your own home or a mortgage. Another good thing about having a mortgage or owning a home is that your property tax and your interest payments on your mortgage may be tax deductible. When you're renting, more than likely, your rent payment is not going to be tax deductible. Now, owning your own home and paying the property taxes, those property taxes could possibly go up a little bit. We could look at the history of that. I'll help you do that, and we'll see how much the property taxes have gone up in the past and what we could possibly expect. Of course, you can, if you work from home, maybe you have an office in the house, in a rental, you can deduct the cost of having an office in your house and work from home. But you can do the same thing if you own a home. You can deduct a little bit of your taxes for a home office if you work from home. So one of the big tax breaks of owning a property is a Section 121 exclusion. So if you have lived in the house for 2 out of the last 5 years, it doesn't have to be consecutively, have this tax break. So if you are single, you get a $250,000 off of your taxable income for capital gains. And if you are married and filing jointly, you get a $500,000 reduction in taxable income. So here's an example. Like if you bought a house for $700,000 and you stayed in it for, let's just say, 2 out of those 5 years you lived in it, and you sell that house for $1 million. So you can apply for this exclusion, and now you only pay taxes on $50,000 because you got that $250,000 off of your capital gains instead of paying taxes on $300,000, which is what you would have earned. The difference between 700 and $1 million. So it could be significant, price reduction on, for your taxes for that capital gains. Some additional tax benefits here in Iowa, or probably in most states, is of course the homestead exemption. You got also the homestead exemption will be increased for seniors that are older than 65, or the military credit for taxes. Also, Iowa is debating right now a proposal that could cover 50% of the home cost for seniors, or up to $25,000 for tax exemption. So that could be big. We're going to watch that one. So next we're going to talk about preparing to buy a home. So the first thing you want to do is assess your readiness. Do you have a steady income? What does your credit score look like? Also, you're going to want to understand what debt to income ratio is all about. This is all so that you can end up getting a good mortgage, a really good loan on your property, because most people are not paying cash for their houses. It doesn't happen very often. So what the debt to income ratio does is it allows the lender to check to see whether or not you are going to be able to pay the mortgage comfortably on this house. So what it does is they take your total debt, everything that you pay on a monthly basis, and they divide it by your gross income before taxes. So most loan officers will want to see the debt to income ratio between 43% and 50%. So as an example, let's say you have a $600 payment for student loans. You've got a $300 car payment for a car loan, and you've got $1,100 in PITI, which is principal, interest, taxes, and insurance. That is a total of $2,000 a month. Let's say your yearly income is $60,000 a year. That's $5,000 a month. That if you take your debt, which equals 2,000, and divide it by 5,000, you get a 40% debt to income ratio. So that's an example of how you come up with it. So you have to think about, how much do I actually have to save in order to buy a house? So that largely depends on what kind of loan you get. If you get a conventional loan, normally your down payment is going to be anywhere between 3% and 20%. If you pay anything less than the 20% on a conventional loan, then you're also going to have to pay PMI, which is private mortgage insurance. And what that does is just make sure that if you default on the loan, that they have enough money to pay off the loan. The good news is on that conventional loan, after you get to a certain threshold, then that PMI is going to go away. The bad news is the whole time that you're paying that PMI insurance, sometimes it's like, $100 to $200 extra per month. It doesn't go to paying off your loan or your interest or anything. It's just insurance. So one of the benefits of conventional loan is a lot of times they have a lower interest rate. Another type of loan that you're going to possibly could get into is an FHA loan. Now the FHA loan, the advantages of that is that your down payment is going to be 3.5%. And also you can get an FHA loan with a little bit lower credit score. The downside of an FHA loan is what's called MIP, which is basically the same thing as PMI. It's insurance just in case you can't pay your mortgage. The biggest downside to that is that the MIP does not go away on an FHA loan. So even if you pay your loan off enough to have that 20% equity in your home, your MIP is not going to go away. It stays for the life of the loan. So there are also other type of loans. You got the VA loans, you've got the USDA loans, which is like rural property loans, and you've also got physician loans and even loans for lawyers or attorneys. But you have to be in a special category to get those loans, obviously, and most people watching this video are not going to qualify for those loans. But those loans have 0% down, so you can get into a house without paying any down payment. So if you do qualify, that's a possible option. I've mentioned in other videos, just read the fine print on those and talk to your loan officer and make sure that they're telling you everything about all those loans. So how much do you actually have to save in order to, buy a house? There are extra fees. You're going to end up paying, in addition to the down payment, you're going to end up paying the closing costs. That can be like transfer taxes, title insurance, lender fees, stuff like that. The best thing to do with that is to talk to your lender. They're going to give you a really good estimate on what those costs are, and depending on what kind of loan you're going to get. But if you're doing this, preliminarily before you've talked to a loan officer, then a good rule of thumb is to save about 2% of the total purchase price, because the lenders are going to want to have 6 months worth of mortgage payments in the bank so that you have some money to pay these loans. They don't want to give you a huge loan first couple of months. You don't have any money in the bank, so they're going to want to make sure that you have enough money saved up in the bank to pay these loans. For example, if you get into the house and lose your job, second month or whatever. So rule of thumb, 2% of the total purchase price saved up in addition to down payment is what you should have, sort of like financial planning in order to get ready to buy a house. All right, so getting a loan is very important. And, in order to get a really good loan, you're going to need good credit. So most loan officers are going to want to see a credit score like above 740. If you have a credit score above 740, like 760, 780, then you're not going to have to worry too much about it. If you're above 740, you're going to get the best interest rates. If your credit score is somewhere around, like 700, like, 680, 700, 720, something like that, then you're going to want to think about possibly doing the best thing you can to just raise your credit score a little bit to get it, around 740, 750. If your credit score is really bad, like below 580, then more than likely you won't even qualify for any of these loans. You're not going to be able to get a loan. So if you've got a credit score, really low credit score like that, then what you're going to want to do is maybe get some help with some programs. There are plenty of programs out there where you can, fix your bad credit, pay off some debt, whatever it takes to get some good credit. And then you can raise your credit. It may not be the right time for you if your credit score is 580 or lower. So for those of you who don't know me, my name is Andre Dugas. I'm a local realtor here in the Des Moines area, and I love helping everybody find a home, even if it's not your first one, but those first-time home buyers are fun to deal with. Here's a couple of tips to improve your credit scores. One of the best things to do is just start looking at your credit and getting the process started as soon as possible. While you're saving the money, you want to look at your credit score and try to increase your credit score as quick as possible. The other thing is, pay off those debts. Pay off as much as you can, all those debts, and especially right before you're ready to go and get your loan or talk to a loan officer. Then you may want to just pay all of them off so that your debt to income ratio looks really good. You don't have a whole lot of debt at all, and that will also help. And of course, after you start the process, you're not going to want to open new credit cards or get new credit cards or get a new loan or buy a new car. Your loan officer is going to tell you that. And anyway, definitely don't do that. It'll ruin the process, and you won't get the loan and you won't get to close on the house. All right, so another one of the first things you want to do is figure out what exactly you want in a home. Worst thing you can do is kind of get into it too quick and not really, I'm just going to go check out homes and I'll see what I like after I see a few. That's really not a good idea. What you want to do is sit down with your spouse or sit down with your family and talk about what you actually want. What's the best location? Do you want to be in this suburb or this city, or how close to Des Moines do you want to be? That sort of thing. Also, you want to look at things like, do you want a yard? Do you have a dog? Of course, you're going to want a fenced-in yard, or look at the HOAs. Do they allow privacy fences if that's what you want? Do you have to have a large kitchen, gas stove? Some people say they have to have, 3-car garages or whatever. So anyway, sit down with your spouse or whoever is involved and figure out exactly what you want in a home. What are the criteria of the homes, so that you don't waste your time and the time of everyone else. So the next thing you want to do is build your team, and the most important person in that team is going to be your real estate agent. That's me. I'll take care of your needs. You may say, well, if I cut that person out, then I won't have to pay a commission. Well, here's a couple of things. The commission is totally negotiable. In today's market, while buyers are responsible for paying their buyer's agent's commission, in most cases, we can negotiate with the seller to help pay for concessions, and that'll help you pay for commission of your buyer's agent. In the Des Moines area market, it's very typical that a lot of times we can negotiate and the sellers are offering those concessions to pay the commission of the buyer's agent. A real estate agent is really worth everything that you're paying for, if you're paying anything at all. They're worth every penny. They're going to help you work through the negotiations. We're going to negotiate what they have to fix on the house. We're going to talk about inspections. I'm going to help you find a great lender. I got a whole list of people that are really great. I'm going to negotiate for you. I'm going to do all the paperwork for you. It's really important to have all that help, especially if you've never done it before. And even if you have, most people who have done it would never try it again without a real estate agent, because it can be a complicated process, and I'll be there to help you through it. The next person you're going to want on your team is a lender. Like I said, I've got a whole list of lenders that I would recommend, or you can go out and find your own. It kind of depends on what your situation is, who you're going to look for, but I always tell people that, find someone who's going to answer the phone, who's not that busy, who you can connect with and talk to, and who's really nice. But what the lender is going to do is one of the first things that they're going to do is get you what's called a pre-approval letter. Now, getting pre-approved is very important for several reasons. One of the main reasons is that when you're looking at houses, and let's say you find a great one, you're going to want to put an offer in on that house right away. Well, if you're not pre-approved, you can't really make the offer. Nobody's going to accept an offer. The sellers are not going to accept an offer unless you're pre-approved by a lender. The next very important part of that is you're going to want to find out from the lender what they will approve you for the cost of a house. You don't want to be looking at houses for $500,000 if all you can afford is $450,000 or $400,000. That makes a big difference. You also don't want to be looking at houses for $450,000 if you can really afford $600,000. Assess what the situation is, but with the help of a lender, they will help you assess that a little better. So to get that pre-approval letter, the lender is going to ask you for 2 years of tax returns. They're going to ask you for 2 months of bank statements. They're going to ask for the last 2 pay stubs from where you work, and they're going to do a hard credit pull on your credit report so they can figure out what kind of credit score. So finally, you get to the buying process. This is a lot of fun. So what you're going to want to do is go online. Maybe you want to go to Zillow or Redfin or wherever and look for houses. You've talked about this with your spouse and everything. Now you know exactly what you can afford. You get the money saved up. You're ready to go. Now you get to go take a look. You can filter those searches. You can narrow them down to a certain area, and you can find houses that fit your criteria. You find a couple that you like, and then give me a call, and I will help you find houses similar to that. There's a chance that you are considering a particular area, and there's another area very similar to that in a different area that might fit your criteria a little better. And I'm really good at helping people look at that and find that. Another little tip is that as you're looking at these houses, you may actually want to filter those searches out so you can look at houses that have been on the market for a while. A lot of times you can get a better deal on those houses. That's not super important. Everybody wants to sell their house. That's why they've got it listed. But you can, if the house has been on the market for a little while, you can get a better deal sometimes on those houses. So next thing, you've got the list. I'm going to send you some. I'm going to suggest some. We narrow it down to about 5 houses, and then you're going to send me that list. I'm going to set it up where we can set up a private tour for each of these houses, and we're going to go start looking at houses. That is a lot of fun, going in there and looking at the houses that you have been dreaming about, and the neighborhoods and the communities. I'm going to tell you all about that, and we're going to look at these houses and figure out maybe which one is the right one. We're going to narrow it down, look at a couple of houses, then we're going to talk about it, and then we're going to find a great house in a great community that you're ready to put an offer on. So for those of you who don't know me, my name is Andre Dugas. I'm a local realtor here in the Des Moines area, and I love helping everybody find a home, even if it's not your first one, but those first-time home buyers are fun to deal with. So now let's talk about making an offer. Now, I've done videos about this, go check them out. But making an offer, you want to make sure that you have a number in mind that you feel comfortable with. You don't need to stick to the number that the loan officer gave you for what you can afford. Let's say the loan officer said you can afford a $600,000 house. Well, that's great. But are you really comfortable with the mortgage payment that you're going to have to pay? Is it going to be at the max of what you're making? And that will really stress you out. You really don't want to do that if that's the case. Let's say you're approved for $600,000. Maybe you ought to look at houses for $550,000 or $500,000. That can significantly help the stress level after you get into the house. So be careful. Don't offer too much. Have that number in your head while you're looking for homes, and stick to that number when you're making the offer. You'll feel much better about it. Your stress level will be much better. So the other thing is, consider the long-term effects of buying a house. The house is going to appreciate in value. Look at the past and look at what houses in this community have increased in the past, and look at the future and the forecasts about what these communities are going to do. More than likely, the house is going to appreciate in value. You're going to have plenty of equity in the house, and your $500,000 house in a little while is going to be worth much more. So think about that. think about the long-term situation. If you're going to live in your house for 10, 20, 30 years, then does it really matter if you paid, $5 or $10 or $15,000 more than the list price? I'm not the list price, more than you wanted to. Think about that. Make sure you're comfortable with it, of course, but maybe $5,000 or $10,000 extra is not really going to make that much difference when you look at the long-term effects of buying a house and the equity that you're going to build in the house. All right, so let's talk about making the offer. When you're going to make the offer, don't get emotionally involved. I know you found this great house, it checks all the boxes. If everything doesn't work out exactly right, then you're going to want to be ready to just walk away. Also, if you're making a really strong offer on the high side of the price or close to list price, then you can ask for a lot of contingencies. You can ask for them to fix certain things or do certain things for you in the house. So, you're going to want to make a strong offer. If you are making a low offer, then you can expect that they're going to be a little bit tighter on the terms of the deal. They may not fix everything you asked for if you're buying a house that's been lived in, and new construction, they usually always do. Anyway, that all depends on whether or not you're making a strong offer. So another part of the offer process is that you're going to have to put a earnest money deposit down. So it depends on which house and who you're buying it from, but you put that money down and it goes towards the cost of buying the house, towards the transaction. But if you back out for no good reason, then they get to keep that money. So you got to be careful. You really want to make sure that you're making an offer on a house that you're not going to back out for no good reason. Anyway, we'll talk about the reasons that you can back out in a few minutes. So for that earnest money deposit, we're going to usually do that electronically, but you're going to have to be really careful about this. Fraud is out there, so you want to verify all that. I'm going to help you with that for the earnest money deposit. Just be careful with that. But anyway, you got to make the earnest money deposit. The other thing you're going to want to do is talk to your loan officer, and you're going to want to lock in the rate. You're going to want to get that going. One of the things that takes the most amount of time during this closing process is getting the loan. So you're going to want to make sure that you give your loan officer everything they need, whatever they need, all those details, all those questions, get that going. The other thing is you're going to want to call around and get homeowners insurance. And the cool thing about it is that a lot of times you get this homeowner policy and you're going to need it for the process, but more than likely you can cancel that if it's not a good fit and get a new policy, easily, maybe right after you get in the home or even before you get in the home. So the first thing we'll do during the closing is, after you put in the offer, is inspections. Now, I highly recommend hiring a very good inspector. I've got a great inspector, or you can hire one that maybe you checked out. But anyway, what's going to happen is this professional inspector is going to go and they're going to check everything out. They're going to check the furnace, they're going to check the walls, they're going to check for water damage, they're going to check the insulation depth in the attic, they're going to check, the roof and just everything about the home. And this is where usually I would recommend like a 10-day period. We'll ask for that in the contract. Usually we get like a 7 to 10-day period. So we want to schedule that right away, get that inspection within the first 5 days, and then you will have a couple of days to talk about what's wrong with the house. This is where if you find some things in this house that are unacceptable, this is where you renegotiate the price and ask the seller to either fix these things or come down off of the price. I will take care of all that. We'll talk about it. We'll see what it is that you want fixed or that you want to come down off of the price. Usually what I say about inspections is that you don't want to worry about the things like cracked electrical outlet or something like that. You want to look at things that are going to cost you more than $500 and ask them to fix those things. Anyway, we'll talk about all that. This is where, in this situation where if you can't agree and come to terms on fixing the things that you need fixed during inspections, that you could possibly get out of the contract and get your earnest money back. Next thing that's going to happen is that the lender is going to order an appraisal. They may do it immediately, but sometimes it takes a little while for the appraiser to get out there. So anyway, that's usually about the second thing that happens. This is where you want to make sure that you've paid the right amount for the house, because the appraisal will go out there and assess the value of the house based on properties that have sold in that area within the last 3 to 6 months, and they'll give you an appraised value with their professional opinion on what the house is worth. Now, why it's so important is that the mortgage company or the lender is not going to loan you anything more than what the appraised value is that you get from this appraiser. So, for instance, if let's say you paid $350,000 for this house, and the appraiser goes out and says, well, guess what? Property is worth $275,000. Well, now the lender is going to lend you that 80% or whatever it is that they're going to lend you for the house. They're going to only lend you based on what the appraised value was. So this is significant. There is a contingency in the contract so that if it doesn't appraise, if it appraises for less than what you paid for it, then you can back out and get your earnest money back. But anyway, so that's the next process. More than likely, most of the time, it comes out all right. The appraisers usually come out right. The seller usually does not agree to accept a price that is much lower than what the appraised value is. A lot of times they know what the appraised value is. If they've got a good listing agent, that price and what they accept is going to be right around what it's worth. But sometimes it doesn't happen, so that's why I'm explaining it. So again, the contingencies where you can possibly get out of the contract and get your earnest money back. There's the inspection contingency. There's the loan contingency. If you aren't able to get the loan, then you can back out of the deal, and also the appraisal contingency. Let's say all that worked out, you got to the closing and you got clear to close, you're going to sign the papers and you're going to get the house, and you may be thinking, well, I've already put the earnest money down. Do I need to put another 20% down or whatever the down payment is on top of that? No. The answer is no. That earnest money will go towards the money that you will need to buy the house. Talk to your loan officer about that if you're concerned about that, but they can explain all that to you. After all that's done, you're going to go to the closing firm. They're going to close on the house. You're going to sign all the papers, and now you've got the keys to your house. Congratulations, you're a new homeowner. So there you go. That's what the process is, and everything you need to be watching out for, and a couple of little tips and tricks to get you through this process. I am definitely going to be there for you and help you through all this process, but I wanted to put this video together so that you could be aware of what's going to happen after you give me a call. So anyway, give me a call. I'd love to help you find exactly what you're looking for, in the great community right here in the Des Moines area. Also, if you're looking in another area, I can help you with that too. Give me a call. I can help you find a great real estate agent in your area. Thanks for watching. I'll see you on the next video.